Welcome to your deep dive. Today we're going to crack open this options trading crash course.
Yeah,
We're going to help you guys become a little bit more fluent in the language of calls and puts and
that's right.
even maybe a little bit of naked trading.
Yeah,
Um,
that's right.
don't worry, it's not what you think.
No, not at all.
Whether you're a seasoned investor or just kind of dipping your toes into the market today, we're going to try to distill the essentials and
Yeah,
sprinkle in some aha moments.
absolutely. And I think options can sound very intimidating at first,
Yeah.
but we're going to break it down,
Yeah.
understand the mechanics,
Right.
and we're going to highlight the unique advantages options trading offers. You'd be
Yeah.
surprised how much control and flexibility you can actually have.
Absolutely.
And yes, we'll address the risks too.
Yeah.
So you're not walking in blind.
For sure. So we're assuming that most of you guys out there already have a pretty basic understanding of stocks and how the market works.
Right.
We're not going to go, too deep into defining calls and puts and all
Huh.
that kind of stuff.
Yeah.
Right? We're going to go beyond that. But before we do, let's address the elephant in the room. The common misconception that options are super risky.
Right. It's true that options can amplify both gains and losses.
Right.
But that's really where understanding them comes in.
Yeah.
I think of options as tools with adjustable risk settings.
Okay.
The key is really knowing how to calibrate those settings
Okay.
to match your own personal investment goals and risk tolerance.
Yeah.
It's less about gambling,
Right.
and it's more about a very calculated strategy.
I love that. So it's about taking control and not rolling the dice.
Exactly.
So one of the first things our source highlights is the difference between buying and selling options.
Right.
When
yeah.
you buy an option, you have the right to exercise it.
Right.
But if you sell an option, then you have the obligation to deliver.
Exactly.
So that's a pretty fundamental dynamic to understand, right?
It really is. And this is where that insurance analogy comes into play.
Okay.
So let's say you are bullish on a company long term, but you anticipate a short-term dip, maybe because of an upcoming earnings report.
Yeah.
Instead of selling your shares, you could buy put options as a hedge.
Okay.
So if the price dips, you profit from the put. If the price rises, your stock gains value and the put simply expires.
So it's like a safety net that lets you ride out the volatility without sacrificing your position.
Exactly. That's a great way to think about it.
That's pretty clever. Our source also dives into the world of selling puts, which seems a bit riskier, right?
It definitely is. It's a
Right.
more advanced strategy.
Okay.
Think of it this way. It's like becoming the insurance company.
Yeah.
Instead of being the policyholder,
Right.
you're essentially saying, I'm willing to buy this stock at this price, even if it dips.
Okay.
So you profit from the premium if the price stays stable or rises.
Okay.
But the risk is being assigned the stock at a potentially unfavorable price.
Okay, so let's say I'm bullish on a stock and decide to sell a put option.
Okay.
How do I determine the right strike price to balance that risk and reward?
That's a great question.
Yeah.
It really comes down to your risk tolerance and your outlook on the stock.
Yeah.
A higher strike price means a higher premium, but also a greater risk of being assigned.
Right.
A lower strike price offers less premium, but a lower chance of assignment.
Okay. So it's kind of a delicate dance. Our source uses a railroad company example to illustrate this.
Yes, exactly.
They do.
So do you want to walk us through that?
Yeah, absolutely.
Yeah.
So let's say you're considering selling a put option on a railroad company
Okay.
that's currently trading at $50 a share.
Okay.
And you're confident that the stock won't fall below $45
Okay.
in the next month. So selling a put with a $45 strike price
Okay.
allows you to collect a premium while being comfortable with potentially owning the stock at that price.
Right, because you think it's going to go up.
Exactly.
Okay. But what happens if I misjudge the market
Right.
and the stock plummets to $40?
Well, that's the risk you take when selling puts.
Right.
That's why it's crucial to have a solid understanding of the underlying asset.
And be prepared to own the stock if assigned.
So you're forced to buy it at $45 even though it's only worth $40.
That is the potential downside
Okay.
of selling puts.
So I'm starting to see how selling puts can be powerful, but it really requires careful planning
Yes.
and research.
Absolutely.
Our source also provides a detailed example with Company A
They do.
to further illustrate buying a put. They even include this handy little table showing various outcomes based on the stock's performance.
Right.
I think this is going to be helpful for our listeners to really visualize
Definitely.
the potential profits and losses involved.
Absolutely.
So let's imagine Company A is currently trading at $50 per share,
Okay.
and I anticipate a significant drop.
Okay.
So I buy a put option with a strike price of $40,
Right.
and that costs me a $2 premium per share.
Okay.
So essentially, I've paid $200
Yes.
because it's $2 times 100 shares
Right.
that the contract represents for the right to sell 100 shares of Company A at $40,
Right.
regardless of how low the stock price drops.
Exactly.
You got it.
Okay, so now let's say the stock does indeed tank
Okay.
and it drops to $30.
All right.
So I exercise my option, I buy the shares at $30, and immediately sell them at the $40 strike price.
Yes.
My profit, after factoring in that $2 premium, would be $8 per share,
That's right.
totaling a cool $800 for the contract.
Exactly.
That's a substantial gain.
It is.
But what if the stock only drops slightly to, say, $48?
In that case, exercising the option wouldn't really make sense.
Right.
Because you'd be selling shares at a lower price than their market value.
Right.
So the option would expire worthless,
Okay.
and you would lose your $200 premium.
Ah, so there's a break-even point
There is.
where the stock needs to drop below a certain level for the put option to even be profitable.
Exactly.
So in this case, the break-even point would be $38,
That's right.
which is a strike price of $30 minus the $2 premium.
Exactly.
So if the stock price falls below $38, you start making a profit.
That's correct. I see. This example really helps to solidify how the mechanics of a put option actually work in practice.
Yeah.
So it's not just about hoping for a price drop.
No.
It's about calculating your potential profit and loss based on the strike price, the premium, and the break-even point.
Precisely.
So we've covered buying and selling puts.
Yeah.
But how do options in general differ from simply buying and selling stocks?
That's a great question. It boils down to ownership versus the right to ownership.
Okay.
Stocks represent direct ownership in a company,
Uh-huh.
whereas options represent the right to buy or sell those shares at a predetermined price.
Okay, so owning stock is like owning a house,
Yes.
while owning an option is like having the right to buy or sell that house at a set price in the future.
That is a great analogy.
Okay, cool. So this is where the concept of leverage comes into play.
It is.
So options often cost less than the underlying stock, allowing you to control a larger position with a smaller investment.
Exactly.
But leverage can be a double-edged sword.
It absolutely can be.
Our source actually cautions that leverage can be as unpredictable as gambling,
Right.
and it can lead to permanent losses.
For sure.
So how can I leverage the power of options safely and effectively?
Well, leverage should always be approached with caution and a deep understanding of the risks involved.
Right.
Think of it like driving a fast car.
Okay.
It can be exhilarating,
Yeah.
but it requires skill
Right.
and responsibility
For sure.
to avoid crashing.
I love that analogy. So it's not about avoiding leverage altogether,
No.
but it's about knowing when to use it and how much is appropriate for your own risk tolerance.
Absolutely.
Okay, so start with a solid understanding of the options mechanics
Right.
and the underlying asset.
For sure.
Then use appropriate position sizing.
Yes.
Diversify your portfolio.
Right.
And employ things like stop-loss orders to limit those potential losses.
Exactly.
This is great advice for anyone looking to navigate this exciting world of options trading.
Yes.
Now our source starts diving into some really cool strategies, which they call combo strategies.
Yes.
These involve, you guessed it, combining options with stock ownership
Right.
to create these unique opportunities.
Yes.
So let's dive into these after a quick break. Welcome back to our deep dive into options trading.
Yeah, we're going to unlock even more strategic possibilities with options.
I'm ready. So we've covered the foundations of buying and selling options.
Right.
And we explored how leverage can be both a powerful tool
Right.
and a potential risk.
It is.
So now let's get into some of these more advanced strategies that are mentioned in our source.
Okay.
Starting with something called naked options.
Naked options.
They sound a bit daring, don't they?
They do sound a little bit daring.
What exactly are those?
So naked options essentially means selling an option without actually owning the underlying asset.
Wait, you're selling something you don't even have.
You are.
Isn't that incredibly risky?
It can be.
Yeah.
Which is why it's a strategy best suited for experienced traders
Okay.
who understand the potential downsides. Let's break it down.
Okay.
When you sell a naked call option, you're essentially betting that the price of the underlying stock won't go above a certain level,
Okay.
which is the strike price.
Right.
If you're right, the option expires worthless and you pocket the premium.
So your profit is limited to that premium you collect up front.
Exactly.
Right to the catch.
So the catch is if the stock price does rise above the strike price, the buyer of that call option can exercise their right to buy the stock from you
Okay.
at that lower price. So you're then obligated to buy the stock at the current market price,
Okay.
which is higher, and sell it to them at the lower strike price, potentially resulting in a significant loss.
Ouch. That sounds like a recipe for disaster.
It can be.
Our source mentions that naked call options are especially risky because there's theoretically no limit to how high a stock price can rise.
That's right. Imagine a sudden surge in demand or some unexpected good news that just propels the stock price through the roof.
Right.
Your losses could be substantial.
So, naked put options, on the other hand, have a limited risk because the stock price can only fall to zero.
Exactly. The worst case scenario is you're obligated to buy the stock at the strike price, even if it's now trading much lower.
Okay, so naked puts are a bit safer than naked calls,
They are a little bit safer.
but still not for the faint of heart.
Not for the faint of heart, exactly.
Our source also mentions options on futures, which sound even more complex.
They do.
What are those all about?
So options on futures are like a double layer of derivatives, adding another level of potential leverage
Okay.
and risk. Instead of directly buying or selling an individual stock, you're essentially betting on the direction of a futures contract.
A futures contract. Can you give us a quick refresher for our listeners?
Sure, a futures contract is an agreement to buy or sell a specific asset,
Okay.
like a commodity, currency, or financial instrument, at a predetermined price and date in the future.
Okay.
So with options on futures, you're not betting on the current price of the asset,
Right.
but on where you think the future price will land.
So it's like a prediction on top of a prediction.
You could say that
Okay.
our source uses a great example involving the S&P 500 E-mini futures contract.
Gotcha.
Let's say you're bullish on the S&P 500
Okay.
and believe the index will rise in the next 3 months.
Okay.
Instead of buying the futures contract directly, which requires a significant margin deposit,
Right.
you could buy a call option on that futures contract.
Okay.
This lets you control a large position with a smaller initial investment, potentially amplifying your gains if the market moves in your favor.
So you're leveraging the power of both futures and options, but it sounds like there are a lot of moving parts to keep track of.
There are.
Yeah.
You need to consider the expiration dates of both the option and the underlying futures contract.
Yeah. Right.
There's also inherent leverage involved, which can magnify both profits and losses. It's definitely a strategy that requires careful analysis and risk management.
Yeah, this all sounds super interesting, but also a bit overwhelming.
I understand.
I'm starting to feel the need for a mental break.
Okay, let's shift gears for a moment and talk about a crucial aspect of options trading that often gets overlooked,
Okay.
which is the psychological game.
Ah, the mental side of things.
Exactly.
Our source touches on this and emphasizes the importance of overcoming fear and anxiety when trading.
It's so important.
Why is that so crucial in the world of options?
Well, options trading, especially when dealing with these advanced strategies like naked options or options on futures, can be a bit of a roller coaster ride.
Okay.
The potential for both significant gains and losses can trigger a lot of emotions.
Right.
Fear of missing out.
Fear of making the wrong decision.
Exactly. Even the thrill of the chase.
I can imagine you're dealing with time constraints and market fluctuations and the pressure of making quick decisions.
Exactly.
So how can someone stay grounded and avoid letting those emotions lead to impulsive actions?
It all starts with cultivating a disciplined mindset and a clear trading plan.
Okay.
Having a set of predefined rules and strategies can help you navigate the market with more objectivity, minimizing the impact of those knee-jerk reactions.
So it's about creating a framework for decision-making that removes the emotion from the equation.
Precisely.
Our source offers some great advice on how to manage those emotions,
You do?
like accepting that losses are inevitable.
Yes. Every trader experiences losses.
Right,
It's part of the game.
right,
The key is not to let those losses derail you,
right.
but to view them as learning opportunities.
Okay.
Analyze what went wrong, adjust your strategy, and move forward.
So turning those losses into lessons learned is crucial for long-term success.
Absolutely. Another important aspect is setting realistic expectations.
Okay.
Don't fall for that get-rich-quick mentality.
Right.
Options trading is a skill
Yeah.
that takes time and practice to develop.
Right.
So focus on learning the ropes, refining your strategies, and gradually increasing your risk as your confidence grows.
That's sound advice for any investor, really.
It is.
It's about playing the long game, not chasing quick wins. Our source also dives into some simple options trading strategies
They do.
that sound quite straightforward once you grasp the terminology.
Right.
So let's walk through a couple of those,
Okay.
just to see how these concepts play out in real-world scenarios.
Absolutely. A simple and common strategy is the long call,
Okay.
where a trader purchases a call option, hoping that the underlying security's value will rise past the strike price within a given time frame.
So let's use a real-world example here.
Okay.
Let's say I'm feeling bullish about Apple stock,
Right.
which is currently trading at $180.
Right.
And I believe it will hit $200 within the next 3 months.
Yeah.
How would a long call strategy work in this scenario?
So you would purchase a call option with a strike price slightly above the current price, let's say $190.
Okay.
Each contract typically represents 100 shares. And let's assume the option costs you $5 per share.
Okay.
So you're investing $500
Right.
for the right to buy 100 shares of Apple at $190 anytime before the option expires in 3 months.
Got it. So I have the option but not the obligation to buy those shares at that price.
Exactly.
Yeah.
If the stock price hits $200, as you predicted,
Mm-hmm.
you could exercise your option,
Right.
buy 100 shares at $190,
Right.
and immediately sell them at $200,
Mm-hmm.
making a profit of $10 per share
Okay.
or $1,000.
That's a 100% return on my initial investment.
It is.
Not bad. But what happens if I misjudge the market and the stock price stays below $190?
Then the option expires worthless,
Yeah.
and you lose your $500 investment.
Okay.
That's the risk with a long call strategy.
Right.
Your maximum loss is limited to the premium you paid up front,
Right.
but your potential profit is unlimited if the stock price keeps rising.
Okay, so it's a calculated risk with potentially high rewards.
See, exactly.
What about the opposite of a long call? A long put.
So a long put is essentially the mirror image of a long call.
Okay.
Instead of betting on a price increase, you're betting on a price decrease. You buy a put option, hoping the stock price will fall below the strike price before the option expires.
Okay.
If it does, you can exercise your option to sell the shares at the higher strike price, making a profit even though the stock's value has gone down.
Let's say I'm feeling bearish about a certain tech company,
Okay.
thinking their stock will drop from its current price of $80 to $60 in the next few months.
Right.
How would a long put strategy work in this case?
So you would purchase a put option with a strike price slightly below the current price, maybe $75,
Okay.
hoping the stock price drops below that level.
Okay.
Let's say the premium for this option is $3 per share.
Okay.
Your total investment for the contract would be $300.
Okay.
If the stock price indeed plummets to $60, you could exercise your option.
Right.
Buy 100 shares at $60
Uh-huh.
and immediately sell them at the $75 strike price,
Yeah.
making a profit of $15 per share
Okay.
or $1,500.
That's a significant return.
It is.
So with a long put, my potential profit is limited to the difference between the strike price and the price I buy the shares at minus the premium I paid.
Precisely.
Yeah.
And just like with the long call, if the stock price doesn't move in the direction you anticipated, and in this case doesn't fall below the strike price,
Okay.
the option expires worthless and you lose your premium.
Okay. I'm starting to see how long calls and long puts can be used to profit from both rising and falling markets.
Exactly.
Our source also briefly mentions short puts and covered calls, but those sound like we're getting into even more nuanced territory.
ER. Those strategies involve selling options, which, as we discussed earlier, comes with a different set of risks and rewards. We can delve into those in more detail in our next deep dive session,
Okay.
as they each have their own nuances and potential applications.
Sounds like a plan. So we've covered a lot of ground in part 2 of this options trading deep dive.
We have.
From understanding naked options and options on futures,
Right.
to exploring the psychological side of trading, and even getting into the nitty-gritty of simple options strategies in action.
Absolutely.
I'm feeling a lot more confident about navigating the world of options already.
That's great to hear.
Welcome back to the deep dive. We're in the final stretch of our options trading crash course, and I'm feeling like we've covered a ton of ground already.
We have. We've explored the foundations,
Yeah.
dipped our toes into advanced strategies,
Right.
and even touched on the mental game of trading. Now it's time to unlock even more strategic tools in your options arsenal.
I'm all ears. Our source dives into some more complex strategies in this section,
Right.
and I'm eager to see how they can be used to really navigate the market.
Let's start with spreads.
Okay.
Spreads involve buying and selling multiple options
Okay.
of the same type, either calls or puts, but with different strike prices or expiration dates.
Okay.
Think of it like creating a custom-tailored options strategy.
Okay, that sounds intriguing.
It is.
Our source mentions 2 main types of spreads,
Right.
credit spreads and debit spreads.
Exact.
Can you break those down for us?
Absolutely.
Yeah.
So with credit spreads, you receive a net credit upfront when you enter the trade.
Right.
It's like selling an insurance policy on a stock. You collect a premium, hoping that a certain price movement doesn't happen.
Okay.
So your potential profit is limited to the premium collected, but your potential loss is higher if the stock moves against you.
So it's a strategy where you're essentially betting on the market staying relatively stable.
You are, exactly.
Yeah.
Credit spreads are often used when you have a neutral or slightly bearish outlook on a stock.
Mhm.
You're profiting from the time decay of the options while accepting a limited risk if the market moves against you.
Okay, that makes sense. What about debit spreads? They sound like the opposite.
You're right. With debit spreads, you pay a net debit upfront to enter the trade.
Okay.
It's like buying an insurance policy
Right.
to protect yourself against potential losses. Your maximum loss is limited to the debit you paid, but your potential profit is higher if the stock price moves in your favor.
So it's like you're paying a premium for the potential to profit if the market swings a certain way.
Precisely. Debit spreads are often used when you have a bullish or slightly bearish outlook. You're essentially limiting your risk while giving yourself the opportunity to participate in a significant price move.
Got it. So credit spreads are like selling insurance, and debit spreads are like buying insurance, but with a more nuanced and strategic approach.
That's a great way to put it.
Okay.
Both credit spreads and debit spreads allow you to tailor your options strategies to specific market conditions and risk tolerance.
Our source mentions that spreads can help reduce risk while potentially increasing profit. How is that possible?
By combining multiple options with different strike prices, you're essentially creating a range of outcomes.
Okay.
This can limit your maximum loss while still giving you the potential for gains. It's like setting up a safety net
Right.
while still allowing room for upside potential.
I'm starting to see the appeal of spreads. It's like you're strategically fine-tuning your risk and reward.
You are. Exactly.
Yeah.
Spreads allow for a more controlled and calculated approach to options trading.
Okay, spreads check. Now our source throws around a term that sounds pretty intense, iron condors. What are those all about?
Iron condors are a combination of two spreads,
Okay.
a bull put spread and a bear call spread, all on the same underlying asset. It's a neutral strategy designed to profit if the stock price stays within a specific range.
So you're essentially betting on the market remaining relatively calm.
You are. Precisely. You're hoping for a Goldilocks scenario where the stock price doesn't move too much in either direction.
Okay.
Your maximum profit is limited, but so is your maximum risk. It's a popular strategy when you anticipate low volatility in the market.
So if you're expecting big swings or a strong trend in either direction, an iron condor is probably not the way to go.
Probably not. Iron condors are best suited for situations where you anticipate the market to remain range-bound.
Got it. So we've got spreads, iron condors,
Right.
and a whole world of other option strategies to explore.
A whole world.
But before we wrap up, let's circle back to something we touched on earlier.
Okay.
The importance of trading simulators.
Absolutely. Simulators are an invaluable tool, especially for those just starting out with options.
Yeah.
They allow you to practice and experiment with different strategies
Right.
in a risk-free environment.
It's like having a practice field for options trading where you can hone your skills without the pressure of real money.
Exactly.
Yeah.
You can test different strategies, see how they play out in various market conditions, and get a feel for the emotional ups and downs of trading
Right.
without putting your capital at risk.
Our source specifically mentioned TraderTwit as a particularly good simulator. Why is that?
TraderTwit is a great option because it offers a gamified learning approach using real-time market data. It's a fun and engaging way to get comfortable with the mechanics of options trading before venturing into the real market.
So it's like a video game for options traders, but with real-world implications.
Exactly. It allows you to make mistakes, learn from them, and build confidence without the fear of financial losses. I highly recommend it for anyone looking to get started with options trading.
Well, it seems like we've reached the end of our options trading crash course. We've covered a ton of ground,
We have
from basic definitions to advanced strategies, risk management, the psychology of trading, and even the importance of practice through simulators. Any final words of wisdom for our listeners as they embark on their options trading journey?
Remember, knowledge is power when it comes to options trading. Take the time to thoroughly understand the concepts we've discussed, practice with the simulator, and never stop learning. The world of options is constantly evolving, so stay curious and adapt to the changing landscape.
That's great advice. And remember, options trading isn't about get-rich-quick schemes
Right.
or following the latest trends. It's about making calculated decisions based on your individual risk tolerance investment goals and a thorough understanding of the market.
Absolutely. Options can be powerful tools for enhancing your investment strategy, but they require careful consideration and a disciplined approach.
Well said. I think our listeners are well equipped to start exploring the exciting world of options trading. We've given them a solid foundation, some advanced strategies to consider, and most importantly, a framework for approaching this complex market with confidence and caution.
I think so too.
Awesome. Well, that wraps up this episode of The Deep Dive. Thanks for joining us. Until next time, happy trading.